Well, good morning, good afternoon, everyone. I'm Elliot, Kallen, CEO of Prosperity Financial Group, and I'd like to welcome you to another episode of Meet the Expert. Very exciting today. We're going to talk about a different subject, estate planning. We are here with Ben Rizzuto from Janus Henderson Investors, a $300 billion company. He's based in Denver, Colorado. And we're going to talk about estate planning and mistakes that happen in estate planning. And I want you to know, as a financial advisor and CEO, I see these mistakes every single day of the week. And so we want to go in avoiding these strategies that are just doomed to failure. And of course, there's all that family fighting that can happen. None of us want to leave that behind. If you need to reach me, I'm at prosperityfinancialgroup.com. That's our website. You can see 60 of these plus on our website, Meet the Expert with Elliot Kallen. And we're now in the top 2% of all financial podcasts globally, which is amazing. It's Elliot, E-L-L, E-L-L-I-O-T, at prosperityfinancialgroup.com and 925-314-8503. So, Ben, let me welcome you.
Thank you, Elliot. It's great to be with you today to talk about, as you mentioned, estate planning and legacy planning.
Right. So, and I want you to know, legacy planning includes leaving money to my children. It includes leaving money for charities sometimes. That's the case. It includes creating a foundation if you've got the net worth to do that. It includes even saying, I don't want to leave anything. I want to die bouncing my last paycheck, and I want to die in my favorite restaurant. I mean, there are lots of ways to create a legacy for yourself. Money is just one of them, and different tools are available. If you want to find out more about these tools, come to me, ask us questions. They're on our website, lots of articles about this too. But schedule a time with me and we'll sit down and we'll talk about estate planning as part of your strategy. So, Ben, let's get right into this if we could. Let's talk about some mistakes that people make right off the bat. The most common, what are 3-4 of those common mistakes you see?
Well, I think, when it comes to this idea of estate planning, is one of the main things that people make a mistake around it is just hesitancy around talking about the issue, right? And I've found that there are a few main reasons why people are hesitant to talk about estate planning. First and foremost is this is inherently a conversation about death, right? And many of us are loath to consider such a thing, or our own demise. No one wants to think about those things. So because of that, there is reluctance and hesitance to talk about estate planning, because somewhere in our heads, we may think, well, if I talk about estate planning, that I'm instantly going to die. That, of course, isn't going to happen, right? So that's one mistake that I find. Another thing that I find with people is they feel that estate planning is overly complex, and there's a lot of legal costs and things that go into it. And yes, there are complexities. There are legal issues that need to be considered. But these are important things to think about. Okay, so that's another reason why folks are hesitant to talk about it. And I think that's why, as you mentioned, it's good to sit down with someone like yourself to go through some of those issues and explain some of those complexities so they make sense to that person and their financial plan, whatever it may be. The final thing that I see is that there's a lot of both financial and non-financial issues that go into this idea of wealth transfer or estate planning. Financially speaking, there's money, there's taxes, there's things like that. But then more importantly, and more interestingly, I guess, is the non-financial stuff, the family things, right? Those are the issues that are difficult for folks to think about and find answers to, because, we're all different. My family functions differently than your family. You have different values than I have. So there's no one right answer to these questions. Now, like I said, I think the way that people should be thinking about this is from the standpoint of legacy. Because if we think about it, each one of us, every one of us, is going to leave some sort of legacy. It's going to be a combination of financial and non-financial. The question is, and the question that people really need to ask themselves is, what is the legacy that I want to leave for my kids, my grandkids, my community, whatever it may be? Is it one of confusion Or is it one of making sure that things are clear and everyone is set up to succeed?
So Ben, let me talk about one of the big mistakes I think people make, and I see this all the time, and that is with good intent, the parents want to be equal with their children instead of fair with their children. And sometimes they own a company or they own property or they've helped their child, one child out of three, do something different. What's the difference between equal and fair? Maybe get into that.
Right. So that is an interesting one because, of course, parents want to make sure that their kids feel as if they love them equally, right? And they may very well love those children equally, but there is a difference between equal and fair. And this really gets into understanding the financial and family issues that affect each and every child, right? So the way that I think about this is I bring up the example of a family with two kids. One kid is a successful surgeon, makes a tremendous living. The other kid is a starving artist, for example, right? So there's two different financial situations for those children. Because of that, parents may say, you know what? We're going to make sure that that starving artist has a larger inheritance so that they can be as or a little bit more financially well off. So, equal is not always fair and fair is not always equal. But the real important thing, whatever the decision is that parents make, whether it's an equal bequest or it's an unequal bequest, is talking to those kids and making sure that they understand what's going to happen. Expectations are set, and those children understand the rationale for those decisions. That helps to make sure that there's no infighting, conflict after parents have passed away.
So here's an example I want to give you where you've got a mom, surviving mother, who's elderly now. She bought each one of her children a house. They had the means. She had the means to do that. The houses are in 3 different states with 3 different values. Obviously, California being the most expensive house. And she had a mortgage, but she paid it off already. So the kids are, when she dies, are going to get free and clear. You've got the executor saying, that's more than enough in my book. I'm good. Leave me whatever you want. No rush. One of the children is almost on welfare and says, wait a second, Mom, don't even sell your house worth multi-million dollars here in California. Don't sell it, because when I come visiting Northern California, I want to be able to use your house and I have no other place to live, even though it's worth millions and millions of dollars. And the other one who lives completely out of state is saying, you owe me, and you owe me everything. What's the mom to do? She's feeling so guilt-ridden about how to handle this. And I said, leave it fairly. You've given different money. It's not the value of the real estate. Is that everybody's going to do very well. Sell your house. 2 of your 3 are going to want the money. Don't let the executor not sell, but got stuck in there and feel emotionally, oh no, what about my sibling? They want to use, don't get rid of that. Kids want the money more than they want the house. Is that fair?
I think that is fair. And that's one of those things that research has shown is one of the things that is always or many times left when parents pass away is a house, or in this case, houses. And in some cases, yes, that may make sense for a person to inherit a house if they have the means to keep it, pay the mortgage if that's still part of the plan, property taxes, things like that. But it may be, as you mentioned, a lot easier and a lot cleaner to just sell the houses, provide cash to the beneficiaries, and let them do what they want or need with it. Now, one of the things we need to think about and probably discuss is what is the tax implication for each one of those recipients, because their tax bracket may mean that they receive an equal amount. They may receive $1 million each, for example, but if they're in a higher tax bracket, it may be a lower net or after tax amount. So those are just some of the things to think about. But making it clear and easy to understand is a great idea, depending on the family and depending on the circumstances.
So the burden of taking care of an aging parent often falls on either the single child, the unmarried child, or the daughter, more than it does the boys, just disproportional amount of time. How does that come into play when I talk about splitting my estate, when you know that some people, when they get old, they get angry and bitter, and they take it out on the closest person to them, which is in this case, the caretaker, most often the daughter. And it creates a horrible situation just of resentment. Now what?
Right. So a couple issues to think about with that idea is one, when it comes to that caretaker, the care that they are providing may be repaid through some sort of inheritance, right? If there's again two children, one is the caretaker, one lives out of state. The parent may say, you know what, because this person is going to do all this stuff to help me as I age, I'm going to compensate them for that, which could lead to a higher inheritance for them. Again, that is something that needs to be discussed and clarified before that parent is incapacitated or can't communicate clearly. Now, even though that's the case, in most cases, inheritance bequests are done equally. Okay, but that doesn't have to be the case. I think the other thing to think about is what are the end of life issues? What are the healthcare issues or concerns that parent has? How do they want to spend the last several years of their life, right? And if we talk about that before they're incapacitated or before they're unable to communicate those things, then we can set up a plan. And as you know, plans are really important to us in this industry. But having that plan allows us to make sure that wishes are met, plans are met, and assets are set aside to ensure that people can be taken care of in a good way and in the way that they would like to be taken care of.
So on a different note, taxes. Assuming that there are both IRA taxes coming in and eventually estate taxes, even though it's greater than $20 million per couple right now, what are some 2 or 3 great ways for families to really cut down the amount of tax that they're going to owe at one point?
Right. So let's just level set for a couple reasons. As you mentioned, for most families, the federal estate tax may not apply because the annual or the estate exclusion amount is $13 million approximately per person. So if your family has over $26 million, then you need to worry about federal estate taxes. That may not affect a lot of people. But to your question, what are some things that folks can do to manage their estate tax? I'd say 3 things come to mind. Lifetime gifts are a great way to take the assets that you have and make sure that someone can do something with them now in the present, okay? Currently, each U.S. citizen can provide $17,000 per person per year without any sort of gift or estate tax, okay? So that's something that we can do. Many times parents or grandparents will take that $17,000 or more and put that into like a 529 for a child or grandchild to fund their education. That's a great way to help that recipient do something good with that money, but it also helps to get assets out of your estate and decrease the probability that there may be any sort of federal or state estate tax. So lifetime gifts are really a good thing to do. The other thing about lifetime gifts is, yes, they have a financial component to them, but there's also a non-financial component to them. By being able to provide a lifetime gift, that's going to make you feel really good, right? If you provide someone with a gift after you've died, as I always say, you're not going to feel anything, right? So that's another reason to consider lifetime gifts. Another thing that we can talk about is charitable giving, okay? Here in the United States, you can provide unlimited amounts to charity that can, again, do something good for the community or do something good for an organization, can also help you feel good about what you're doing for that community or organization. It may also be a way to pass on that value of philanthropy to the next generation. So providing to charity is a great way to do that. And if you do it right, depending on the assets that you have, you won't see any sort of tax hit. The charity won't see any sort of tax hit. And then finally, the more complex thing to think about are trusts. And there's all sorts of trusts and legalese that we can talk about when it gets to trusts. But those are simply legal structures where we can hold assets that get them out of our estate. I'm not going to go into too much more depth on that because they can get complex, but that's another idea depending on the family and depending on their level of wealth.
Great. And we're talking with Ben Rizzuto of Janus Henderson Partners out in Denver, $300 billion company. And he is the wealth strategist, but we're talking about estate planning today. Ben, I got a couple more questions. This has been great. And I want to remind everybody that what you just said, I'll piggyback on what you just said about gifting in 529, but gifting at $70,000, it's not just $70,000 to my child. It's to my child, my grandchildren, their spouses, friends, family of friends. It's unlimited.
Anybody.
If you want to dispose of money, it's any way you want to do it. Now they could turn around and they could do whatever they want with their money that you've given them. So you've given 10 people 17,000. They want it, all 9 of them want to give it to the other one person separately. That's their business. They do that. So it is a way to get around it.
Mm-hmm.
And then most 529s allow you to pre-fund 5 years in advance.
Okay.
So 5 times 17, which is great. And you get a one-time write-off of that too. And then you don't have to fund it ever again, because if you have enough time in there, it'll get to the maximum. So on that. And then I want to add one more thing to charity. As you know,
Mm-hmm.
as someone who was CEO of brighterday.info, a California charity that deals with stress and personal resources, that talk to us about, it doesn't matter about our charity, whatever is important to you, including maybe your own foundation, because that is a great way to work with it too, if you have the net worth to do that. And that is grats, actual cash, life insurance as proceeds, and real estate, including real estate rental property, to take out of your estate now and put them in some type of irrevocable way to give it to the charity and get a tax write-off today. Or if it's important to you that real estate come in and go out of your trust, that you might get a partial deduction today, as well as a charity benefit as well. And a charity could be a church or a synagogue. It doesn't have to be a Brighter Day or American Cancer Society or diabetes. It could be because going to church on Sunday or going to synagogue on Saturday is important to you. It's an important way of life. And then a foundation, if you're worth $5 or $10 million or above, and you want to really change the next generation, Ben, as you just mentioned,
Mm-hmm.
if you put that into your own personal foundation, you must give away 5% of it a year. And that means that if you've got a child that, let's say, is struggling to find a career path, and your other two, as you mentioned, one's a lawyer, one's a doctor,
Mm-hmm.
and child number 3 is really struggling, you could name that child as CEO of your foundation. And that child, because they have to give away 5% of 10 million, that's $500,000 a year. They will be invited to charities and black tie balls every week for the rest of their life. And they will have created some self-importance and done really good by society.
Yep, totally.
And then one more thing, of course, you could do on a personal level is you could do a donor advised fund, and you don't have to pick the charity today. You could stick it in there. We do it with Schwab. You can put whatever you want in there, take a tax deduction for that, as long as it's within your personal exemption requirements, and decide somewhere down the road while you're still alive, which charity you want that going to.
Or, to your point kind of earlier, parents could take money, put it into that donor advised fund, and then say to that child, hey, you figure out what we should do with this money. That again allows those parents to pass on that idea, that value of philanthropy, gives that child something to do, helps them feel good about themselves and the wealth that their family has created.
Just a couple little quick questions at the end here. This has been great. What's the difference between a will and a trust?
Right. So a will is simply your instructions, right? This is what I want to happen with my assets once I pass away. How should they be divided up? What are the rules? What are the parameters as to when and who will receive it? The trust is going to be the actual structure or thing that may hold those assets in the future. So that's the main difference. And that's, I think, an important point. Wills and trusts, many folks may have them, but a lot of folks don't. And I think that would be step number one. If you don't have a will, make sure that you get one set up. All right. We at Janus Henderson did some research last year asking participants about their bequest intentions, how they wanted to dispose of their assets. And what's interesting is we had to take 54% of the participants out of the sample because they didn't have a will, right? So that would be step number one. And I think that's a great year-end task to have if you are a family. Sit down, make sure you have that will so that there are those instructions available to your executors, whoever they may be.
I think that's great. I think we just got to make sure we're doing it right. And lastly, I'm back to family dynamics again, because I have to deal with the emotional side of it.
Right.
And I want everybody to know who's listening to here that it is so complicated, family dynamics, because of the emotions of people dying. One is closer to the one parent who's dying. The other one might have been closer to the other, or felt completely disposed of and discharged as a family member. So all these things come back into play when we're talking about family dynamics. And sometimes we get abusive. You know, I saw in my own family as my dad and even my mother became more incapacitated, that my sister, who was taking care of my mother especially, started to do things that today I find abhorrent. Horrible the way she treated her. Horrible. But she was able to manipulate her as a lawyer to get everything she wanted at the end of the day. And so there are an awful lot of family dynamics. And sometimes we can protect against that, and sometimes we cannot because of the emotional side of it. So if you've got that in there, besides just family counseling, which some people do need during the process, is let's talk about where the money goes. And one more thing, as you may want to comment on this, Ben, is when you've got somebody that does not really understand doesn't understand money. And if you leave them whatever you leave them, they're going to blow through it in a short period of time, while the other ones will use it over a long period of time. There are ways, I'm sure you've seen them, to protect the person almost from themselves.
Right. And that's a great point. And it speaks to one of the stats that I talk a lot about when it comes to wealth transfer. Many of our listeners would probably be surprised to hear that 70% of wealth transfers fail. And that failure is defined as assets being involuntarily taken out of control of one or more of the beneficiaries. Now, the question that first comes to mind is, well, why is that? And many would think it's got to be a tax or finance issue. But actually, the reason is because there's a lack of trust and communication. That's the first main reason. The second reason is just lack of preparedness or lack of financial literacy of the beneficiary. So two things that I would say that can help guard against that. One is helping prepare your heirs while you're still alive. Okay. One way that I think is great to do that is to bring them into the conversation around wealth. Talk more freely about what you have, even though money can be a taboo issue. I think talking more freely about it helps to turn down the temperature and make it something that is part of your family's culture. So doing that within a family is great. I think sitting down, parents, children, financial advisor, sitting down in what we call a family money meeting is a great way to bring them into the conversation and, again, increase their overall financial literacy. Now, if we want to get more technical and, again, protect them from themselves, that's where we may talk about trusts and something called a spendthrift provision, which may set certain provisions or hurdles, let's say, that a beneficiary would have to meet or overcome before they received that wealth. So that's one way to ensure that a beneficiary doesn't get everything up front. They don't blow through it before they reach the age of 25 or 30, and they're set up for the long term.
Right. Well, we've been listening to Ben Rizzuto talking about estate planning, and I hate to use this horrible phrase, but you can see there are so many ways to skin a cat here. That's probably a phrase that should go away. But estate planning can be very complicated. Not only are the trust, shelter trust, bypass trust, AB trust, crummy provision. There are lots of words we can use here, but then you've got the emotional baggage associated with these, right? And you've got the family that says you owe me versus you've already favored my sibling his whole life. How about leaving me something, or vice versa? So if you've got these questions, this is the time to sit down with people like myself here at Prosperity Financial Group. And if you want to talk to Ben, if we have to, we'll get Ben on the phone because he can help you with this too, or just sit down with us. So I want to thank you, Ben, for joining us today.
Elliot, it's been great talking, and I hope folks have walked away with a couple of things that they will talk to their spouses, their significant others about when it comes to estate planning. And again, I would remind folks to think about this issue. We all leave a legacy. What are the goals for you and your family? Make sure you're thoughtful about that. And also remember that, as Elliot just mentioned, there's folks like him, there's folks like me that are out here to help you with all of these issues. So again, thank you, Elliot. Happy to be with you today.
Thank you, Ben. And we've been talking about estate planning. Come join us on the next episode of Meet the Expert. We'll look forward to seeing you there. Have a great day.